Hi everyone, happy Wednesday. This is Jane Lovsky, your partner for bookkeeping and operational support. And with me today, I have Irene Sky, who is a partner at Sky and Univer PC, and she's your partner for employment law. And today we're going to talk about a little more about trust accounting. And trust accounts are usually used by law firms to hold client funds they have accumulated through a variety of different means. So, for example, it could be a retainer. A lawyer often charges a retainer when they first begin representing a client. So, this is used as a security deposit and then it's used against future billings by the lawyer. Then it could be a legal settlement that we talked about previously, such as workers' compensation awards or personal injury settlements that are often paid out by insurance company. So it goes directly to the lawyer, and then the settlement must immediately be deposited into a trust account and to be held until distributed by the lawyer to the client. And then the real estate transactions. A lawyer who performs real estate transactions will often have the funds related to those transactions go into the trust account and then maintain a separate trust account dedicated exclusively to handling real estate transactions such as escrow payments, loan payoff, real estate agent commissions, homeowners insurance payments, and so on. So it's very important to have these separately. And then some of the features of the trust account is that the lawyer cannot commingle or mix any personal funds with funds received in the role as a fiduciary on behalf of a client or third party. The trust account prevents from any of these types of funds and commingling. So also there is a separate client ledger for each client where the money is held in the trust account. And so at any point, a client can ask to see specific ledger. So it always shows transactions that flow in and out of the trust account for that specific client. And so each client should receive the ledger at least once per year, or at least when the client's money held in the trust has been distributed. So it's every client's right to see that. And then most importantly is that the lawyers cannot keep any interest earned on funds held in the general trust account. All interest earned by a trust account is remitted to the IOLTA. So it's very important. And for the also accounting wise, so for the trust accounting, none of the transactions should appear on the profit and loss. Everything is kept on the balance sheet. And so from this point, I'd like to ask Irene what kind of situations she's seen, because I'm sure since you deal with a lot of the situations, you know a lot of scenarios that our listeners could keep an ear and eye out.
Thank you so much, Jane. Yes, so aside from everything that Jane said, that of course you can run into your questions with your attorney of making sure that your account is kept separately, or rather even your funds are kept separately. But also it's important from as the client to make sure that if you're asking for an attorney to hold funds in escrow, and your attorney should make sure that they do this as well, but it's good to know beforehand that there has to be a basis for leaving those funds in a certain escrow or trust account. We've very often seen questions arise later, especially when the funds are left for a long period of time. And we've seen, whether it's going to be the state or the IRS, ask questions of why were the funds kept for so long, and is there a certain contract or a basis why these funds weren't paid out, especially if these funds would otherwise be subject to a certain income tax. And really what they're reviewing to see is were funds just kept in escrow as a way of avoiding a certain income tax by the client. And so we always want to make sure that if funds are kept, especially for a long period of time, in an escrow trust account with an attorney, there's a basis for doing so. And that can be a contract from a sale of a business, and so funds are being kept there. But it'll go further. Why are they still being kept there if the transaction is closed? Or is this a down payment in contemplation of a certain real estate purchase or of a certain business purchase? And so if that's the case, again, as long as there's an agreement, as long as there's a contract and everything, all the paperwork is in order, you'll be able to show the basis for why those funds were being kept there and why those funds were being kept in an escrow or trust account. Also, it's very important to make sure that if funds are deposited from one business, and we see this so often come up, where funds are deposited by one business, we'll call it ABCD Incorporated, and that is an active company. And the reason why that company is depositing funds is for the purposes of acquiring another business. But when they acquire that new business, even if it's related to the work that they already do, when they acquire the new business, they're going to right away before closing, very often, it's not by any means mandatory, but what we see often is that they'll go ahead and open a new corporation. And this really raises a question where you have to make sure that you're doing so working together with your accountant. Because if you have funds being transferred, again, we'll use the example of ABCD Incorporated, and those funds are being transferred for down payment of acquisition of a business. But then you have another business that's incorporated right before closing that's going to go ahead and use that benefit of those funds, acquire the business, and continue running it. Then, of course, there's going to be questions. First of all, where did that new business get the money? Was there a certain promissory note for this money? How long was it kept in there? So it's very important to make sure that all of these items are documented. Again, this is just these are just a couple of examples of what we've seen and questions that we've seen arise. But it's because of this that it's important beforehand and before any transaction is made, such as one where funds are being deposited for the purposes of acquiring another business. It's important to really map out what the next steps are. It's always important to look 4 steps ahead because these contracts should be established beforehand. If it is a loan or if it's an investment, that needs to be established beforehand. These documents really need to be created and then funds should be deposited afterwards. So again, it's just a couple of questions, and we've seen so many other questions arise when it comes to transactions, especially having to do with funds then being kept in escrow, trust accounting. So if there are any other questions, always feel free to reach out to Jane and I, and we're happy to help at any time. Thank you, everyone.
Thank you. Bye.